It is 10:10 a.m. Pacific Daylight Time. It's the 13th day of May, 2026, and this is episode 1320 of Bitcoin. And the washing machine is cranking up because the Senate has confirmed Kevin Warsh to the Fed board. We're going to start out with that one today here on Bitcoin and with me, your host, David Bennett, with all the news and macro that you can use from around the world and more. Then we're going to talk about Square crossing 1 million Bitcoin-enabled merchants. Charles Schwab has launched crypto trading for, quote, first group of clients. And then Franklin Templeton will bring us into futures and commodities, the middle part of the show. I might add something there. I'm not exactly sure. We'll have to see what comes up. Then in the second part of the show, we got to talk about BRCA and the market structure, the Clarity Act, because we're kind of in a do or die thing on Clarity Act, and there's this I think it's section 604 is where BRCA is coming into play, and we've got a piece about it by Kyle Olney from Bitcoin Magazine, and then let's see, the CFTC is getting in the corner with Kalshi in the boxing ring, and then we're going to end up talking a little bit about Metaplanet. But let's get back to the Senate confirming Bitcoin-friendly Kevin Warsh to Fed board. Bitcoin Magazine's Micah Zimmerman. President Donald Trump's push to install Kevin Warsh, as the next chair of the Federal Reserve moved closer to completion on Tuesday after the Senate confirmed him to the Fed's Board of Governors, a step that clears the path for a final vote on the chairmanship later this week. The Senate approved Warsh in a 51-45 vote that fell pretty much along party lines, with Senator John Fetterman joining Republicans in support of the nominee. If confirmed as chair, Warsh would replace Jerome Powell, whose term leading the central bank ends this Friday. Warsh's rise has drawn attention across financial markets and the Bitcoin industry because of his support for Bitcoin and, of course, his ties to crypto-related firms, which is unforced errors there. Whatever. Unlike past Fed leaders who treated digital assets with skepticism, Warsh has described Bitcoin as an important asset and a very good policeman for policy, arguing that its price can reflect confidence in the Federal Reserve's handling of inflation and monetary policy. Quote, Bitcoin doesn't trouble me, Warsh said during a Hoover Institution event last year, where he framed the asset as a signal of monetary credibility rather than a threat to the U.S. dollar. His confirmation follows financial disclosures showing Warsh held an equity stake in Flashnet, a Bitcoin payment startup focused on Lightning-style transaction infrastructure for merchants and fintech companies. The disclosure marked one of the clearest links yet between a potential Federal Reserve chair and a company tied directly to Bitcoin adoption. Warsh has also maintained ties to the crypto sector through advisory work and investments connected to digital asset firms, including Bitwise and stablecoin project named Basis. At the same time, Warsh remains known as an inflation hawk. During his earlier tenure as a Fed governor from 2006 to 2011, he warned about inflation risks and criticized loose monetary policy following the financial crisis. Recent comments calling for regime change at the Fed and signaling openness to lower interest rates have created debate among investors over how he would balance inflation concerns with pressure from the White House. Markets now face a transition or a Fed transition during a period of renewed inflation pressure, rising geopolitical tensions, and an uncertainty around future rate policy. Bitcoin traders and crypto investors are watching closely to see whether Warsh's views on digital assets, translates into a shift in tone from the nation's most powerful financial institution. And that's the end of the article, but I'm going to add most likely the world's most important financial institution. The Fed pretty much, when the Fed sneezes, the UK catches a cold, that kind of thing, right? So Warsh seems to be in, unless something really weird happens. We're going to have our new Fed governor installed sometime after Friday. And it will probably be sometime in the next 2 to 4 weeks or something like that is the talk that I'm hearing. But he has said good things about Bitcoin. And he said bad things about inflation. And the problem is that we have inflation, and we'll get to that later on when we run the numbers. We'll talk all about it. But we've got inflation. And it's not good inflation. It's kind of like it's running pretty hot, and this is the first numbers that we've gotten that are really solidly affected by what's going on with the Strait of Hormuz. So there's that. So now, under normal circumstances, I like balance. I like somebody who likes Bitcoin, but is also clearly able to see the writing on the wall about inflation and other matters. So the question becomes, will he be somehow balanced between Bitcoin and the needs of inflation? Or will he just say, fuck Bitcoin, let's go all in on inflation and raise Fed rates, which is starting to become a possibility. Anyway, let's talk about Square. That's Jack Dorsey's outfit. Square crosses 1 million Bitcoin-enabled merchants as real-world adoption continues to grow. Again, Micah Zimmerman, Bitcoin Magazine. Block Inc.'s Square has crossed a threshold of roughly 1 million merchants now enabled to accept Bitcoin payments. The figure, cited by a member of Block's team, reflects a wave of auto-enrollment that began March 30th when Square automatically switched on BTC payments by default for eligible U.S. sellers. At its peak pace, a new business was activating the feature every 8 seconds. The rollout is powered by the Lightning Network, enabling near-instant settlement while merchants receive U.S. dollars by default, removing currency risk from the entire equation. In other words, customers can pay in Bitcoin via Lightning while merchants still receive dollar settlements, with the system handling conversion all in the background, allowing users to just opt out if needed, in case they actually want the Bitcoin, which some of them will, and more of them later on will. I guarantee it. Anyway, at the Bitcoin conference in Las Vegas, Block outlined an expanded push to make Bitcoin usable as everyday money rather than simply a long-term investment. Speaking at the Nakamoto stage, Bitcoin product lead Miles Suter said BTC must circulate, not just sit still, arguing that the cryptocurrency loses its transformational value if it does not function as peer-to-peer cash. Suter highlighted Block's growing adoption metrics, revealing at the time that there were more than 800,000 Square merchants who now have Bitcoin payments auto-enrollment enabled. This number seems to be above, according to Suter, a new business. Hold on. Something's wrong here with the sentence. This number seems to be above, according to Suter, a new business activates the feature every 8 seconds. That is a terrible sentence. I'm sorry that I'm tripping over this, but that is what the hell, dude? Y'all need to hire me as an editor. This is ridiculous. Anyway, the company is also rolling out a tap-to-pay BTC feature using NFC hardware in the Lightning Network, eliminating QR codes and offering zero processing fees through 2026. The company's broader strategy centers on integrating Bitcoin across its ecosystem. Cash App users can now automatically convert peer-to-peer payments into Bitcoin, they can earn 5% Bitcoin back rewards at Square merchants and withdraw up to $10,000 per day and $25K a week. Block also introduced an updated BitKey hardware wallet, introducing a touchscreen and 2 or 3 multi-sig security, blah, blah, blah. We don't need that. What we need to really know from Square is exactly how does this work? I'm having a problem here understanding what they actually are trying to say. Square automatically switched on BTC payments by default for eligible US sellers. Now that we've heard several times. But I don't understand where is it? Where's the 8 seconds thing? Hold on for a second. Every 8 seconds. I'm looking for every 8 seconds. Yeah, it's right here. At its peak pace, a new business was activating the feature every 8 seconds. What does that mean? If Square automatically switched on BTC payments, then everybody should have already had it switched on. So what are we activating every 8 seconds? See, this is the kind of shit that drives me crazy, because it's still confusing exactly what the hell's going on with Square. So what I'm going to continue to assume what I've been assuming for a long time now, is that if you are a merchant and you use Square as your point of sale, you don't have to do nothing. It's already on by default to be able to take Bitcoin via the Lightning Network at your point of sale terminal, whatever that is, whether it's like a nice little cash machine looking thing, or if it's just that little thing that you plug into your phone, whatever, right? It seems to just be on by default. I'm going to just dispense with the confusion created by a new business activating the feature, because it sounds to me like the feature has already been activated, but that's just me. Maybe I just have too few brain cells left. Moving on to Charles Schwab. They've launched crypto trading for their first group of clients. This is Armin Hasquanis out of Cointelegraph. Charles Schwab has begun rolling out spot Bitcoin trading to its first group of retail clients, expanding direct crypto access inside of one of the US's largest brokerage platforms. Quote, Schwab crypto accounts are now being rolled out to retail clients, the company wrote in a Tuesday post on X. Quote, starting today, the first group of clients are able to trade Bitcoin at Schwab right alongside their other investments, end quote. The firm, which manages more than $11 trillion in client assets, serves tens of millions of retail investors, first announced in April that it is rolling out spot crypto trading, and at the time, the brokerage firm said clients will be able to trade and view crypto alongside stocks and other assets across Schwab's web, mobile, and Thinkorswim platforms, with custody held by its banking unit and execution handled through Paxos. The service will carry a fee of 75 basis points for every transaction and will initially exclude residents of New York and Louisiana. The launch expands Schwab's existing crypto offerings, which already cover ETFs, futures, and digital asset funds. When a traditional broker of Schwab's scale integrates crypto directly into standard brokerage accounts, it brings digital assets into mainstream investing for millions of ordinary investors. Chinese language crypto news account Hashnews wrote on X. The user noted that for investors with 401k and standard brokerage accounts, buying Bitcoin becomes as straightforward as buying Apple stock, reducing the friction that previously pushed retail investors toward dedicated crypto exchanges or indirect exposure through grayscale products and ETFs. Quote, this isn't a trading call. It's a signal at the infrastructure level. Crypto assets are shifting from alternative investments to standard allocations, Hashnews said. And last month, Schwab reported record first quarter net income of $2.5 billion, or a $1.37 per diluted share. That's up 30% year over year as total net reserves climbed 16% to $6.5 billion. Adjusted earnings per share came in at a $1.43. That's up 38% from a year earlier, while total client assets grew 19% to $11.77 trillion across 39.1 million active brokerage accounts. Dude, this Charles Schwab thing is kind of big. So here's the issue, though, because there's always an issue. The more Bitcoin becomes allocated into standard trading protocols and thought processes and, just the way that you feel about it, it's no longer this, weird asset that the geeks and nerds were playing with. Now it's like anything else. Well, then that exposes Bitcoin to everything else, like what we're seeing with the price of Bitcoin this morning. We didn't used to see these kinds of price swings given certain mainstream financial and economic news. But now we do. And the question that a lot of people have is, what the hell's going on? Well, it's what the hell's going on is that Bitcoin is in the hands of traditional finance bros. And traditional finance bros have Bloomberg terminals, and they look at numbers like CPI and other inflation factors, and they'll be looking at house sales and retail sales and all kinds of shit month over month. And what I've been seeing as a trend as of the last year and a half, basically about a year and a half, 2 years, I'll give it 2 years. We're seeing a lot more correlation with the price of Bitcoin towards legacy financial and economic news than we had for the entirety of its lifespan before. So there's that. Just, be aware it's not going to get any better. Now, at one point or another, traditional financial news will be flashing things that basically tell people you better get out of the dollar and you better get out of real estate and you better get into something that can't be, hosed down or confiscated. And there's pretty much only one thing that fits that bill, and that would be Bitcoin. BitPaste. It is time for the Circle P. You want some vanilla paste? It's like vanilla extract, only it's a paste because it's got basically a whole bunch of solid vanilla bean in it. Instead of just soaking vanilla bean in alcohol and extracting the flavor, this is, it's the whole bean, pal, because it's the Circle P. It's where I bring plebs just like you with goods and services to plebs just like you who want to buy those goods and services. But you will be buying it in Bitcoin, because if you're not selling in Bitcoin, you're not in the Circle P. You can get BitPaste. He's got 8 in stock, 25,225 Satoshis right now for a 4-ounce jar. And it's got like 2 ingredients, it's got like a couple of ingredients. It's organic cane sugar, vodka, water, and organic Madagascar vanilla beans, along with a little bit of organic blue agave nectar and some xanthan gum. And that's just kind of like a food thickener. And it's all natural. He doesn't use anything unnatural in his BitPaste. And this is Kidwarp's Vanilla Shop, by the way. He doesn't really... Hold on for a second. I want to make sure that I don't have... He may by this point have a full website for it, but right now he is using takemysats.com. That's takemysats.com. It's a storefront for a whole bunch of vendors. And Kidwarp's Vanilla BitPaste is there. I will have a URL, a link direct to the page so you can just go buy it directly. Make sure you use code Bitcoin and for 10% off. Use Bitcoin and you'll get 10% off of your order. He makes this stuff by hand. He uses the best ingredients he can find, and people rave and rave and rave about this product. And he's a pleb just like you. He's a Bitcoiner just like you. That's why he sells his stuff in Bitcoin. So go Click the URL in the show notes. Go buy some BitPaste from my friend Kidwarp and make sure you use Bitcoin and for 10% off. So Franklin Templeton, they and Kraken parent Payward have teamed up to tokenize Wall Street products. Oh, I'm sure this will be just fine, and I'll explain why in a little bit. This is Andrew Hayward writing for Decrypt. Payward, the parent company of crypto exchange Kraken, and Franklin Templeton announced on Tuesday a strategic collaboration aimed at moving mainstream financial products onto blockchain networks, a deal that underscores how the boundary between Wall Street and digital assets markets continues to erode. The partnership pairs Franklin Templeton's global asset management and tokenization expertise with Payward's crypto-native trading, custody, and on-chain infrastructure spanning tokenized equities, qualified custody, activity or actively managed yield products, and direct access to institutional crypto liquidity through Kraken's over-the-counter and prime services. Kraken also plans to integrate Benji, Franklin Templeton's suite of tokenized money market funds, into its platform, where the funds could serve as collateral or cash management tools for institutional trading clients seeking blockchain-based alternatives to traditional treasury operations. Quote, Payward and Franklin Templeton are building toward a model of finance where the distinction between traditional assets and digital infrastructure no longer holds, said Payward and Kraken co-CEO Arjun Sethi in a statement. Quote, the convergence between those two worlds is only going to deepen, and what collaborations like this one unlocks is a new class of products that wouldn't have been possible even 3 years ago. Assets that carry the credibility of a multi-decade manager and the programmability of digital infrastructure. Hold on for a second. Payward and Kraken co-CEO Arjun Sethi. Oh, okay, because that's right. For some reason or another, I thought Franklin Templeton was a little closer to this fire than I thought. I don't know why, but it looked like they might, like Franklin Templeton and Kraken might actually share a co-CEO. No, I forgot. Payward is the parent company of Kraken. That's why I stumbled and fell right there. My apologies. Anyway, Payward's X stocks framework, which has processed more than $30 billion in volume since launching just last year, will explore new actively managed investments on chain, with Franklin Templeton making strategies from one of the world's largest asset managers tradable on a blockchain. Woohoo, what could possibly go wrong? The firms plan to make some of these products available to institutional investors and, in certain jurisdictions, to retail Kraken users. The announcement arrives as Franklin Templeton has accelerated its push into digital finance. The firm recently launched a dedicated cryptocurrency division called Franklin Crypto, anchored by its planned acquisition of crypto investment firm 250 Digital. Quote, the focus should be on making on-chain assets more functional for the full range of market participants once they are there. By expanding the utility of Benji and exploring new tokenized products, our work with Payward reflects the growing need to serve both digital native and institutional customers with solutions built for how capital increasingly moves on-chain. So that whole story was basically to premise this next story. So let's recap what we just read. Franklin Templeton and Kraken are teaming up to tokenize all manner of Wall Street products. We're talking about legacy products. Sometimes they say, oh, it's going to be new. No, what they're doing is they're making a new kind they're making these products available in a new kind of way. Same products, different delivery mechanism. Blockchain. We're going to tokenize everything. Well, Do you remember what the story was that I brought you yesterday about Anthropic calling bullshit? Well, it's not just Anthropic now. Jose Antonio Lanz is writing this one from decrypt.co. Anthropic and OpenAI warn buyers. Unauthorized AI startup shares may be worthless. So OpenAI has joined the fray. All right, well, let's see what they say. Anthropic and OpenAI have both updated their stock transfer policies on Tuesday. And the message is the exact same for both. If you bought shares through an unauthorized channel, you may not actually own anything than an expensive piece of paper. Anthropic's updated page says any sale or transfer of its stock without board of director approval is void, not voidable, nor disputed, voided. The buyer would not be recognized as a shareholder, and the buyer would have no rights. Now, I brought that to you yesterday. Since I brought that to you yesterday, OpenAI has made a statement. An OpenAI statement from today, Wednesday, one day later, uses nearly identical language. Any transfer without written consent is void, and the sale will not be recognized and carry no economic value to you. End quote. Both companies name the same list of targets: direct sales, special purpose vehicles, tokenized interests, and forward contracts. Tokenized interests, I think I'm right when I say the following. They don't mean tokenized interest like you're earning a yield. They mean an equity that was tokenized. That is a tokenized interest. Maybe it's like a tokenized, I don't know, maybe they got a different kind of preferred equity or something like that. What they're saying is like, dude, if it's something that we sell in legacy financial land as a stock or whatever product we're selling that is tradable on the open market, if it is tokenized by some third party and we do not approve that tokenization, then we are not going to look at that share as having any kind of voting power. It has no economic value. It's worthless to you, and it means nothing to us. And what did we just get finished reading? Franklin Templeton and Kraken are not small fish swimming in a small pond. They are relatively large fish swimming in a relatively large pond. And they're going to tokenize a lot of stuff. And now we've got Anthropic and OpenAI both saying the exact same thing. This may not be worth anything to you. If our board of directors did not validate this, then you're screwed. But that's not going to stop people from selling the thing. See, that's the problem. This is basically a 100% cover their own ass. They're like, look, man, you want to buy tokenized OpenAI stock, you go right ahead, brother. We're not going to look at it. We're not going to give you any voting rights. As far as we're concerned, it's irredeemable. We don't give a shit that you lost your money buying paper. That's what both of these companies are saying, and I guarantee you, these are not going to be the last companies to come out and say the exact same thing. In fact, this is probably going to now be forever enshrined in every company's board of directors' rules of reading, or whatever you want to call them, their mandate, their charter, however you want to put that. Just saying. The entirety of what's going on here with this tokenization of equities and assets and products and whatever is going to put a lot of people that aren't watching this shit very, very closely, too close to a fire that they will not be able to escape from. It will be like buying shit coins in 2017. Don't fall into the same trap. This to me looks exactly the same. It's going to be the exact same craze, and it's going to get the exact same people or the exact same amount of people in the exact amount of trouble financially that we saw with a whole bunch of shitcoiners post 2017. So please, for the love of God, be careful out there. Meanwhile, we are going to run numbers. CNBC futures and commodities. Well, energy is down this morning. Lots of stuff is going to be down this morning. Brent North Sea is down 1.5 points, but it's still pretty pricey, $106.07 a barrel. West Texas Intermediate down 0.5 to 101.61. Natural gas acting as the hedge this morning, 0.8% to the upside to 287 per thousand, and gasoline is down almost 2 full points to 362 a gallon, and Murban crude itself is down 0.8% to 105.15. Now, metals are screaming this morning. Platinum is up 3.5 points. Silver is up 4 to $89.08. Copper is up 1.9% to, I never read the copper price, but it's 6.66. Number of the beast, baby. Palladium is up 2.6%, and gold bringing up the rear, up 1/3 of a point to 47.04 and 6 dimes. Ag is mostly in the green today. Biggest loser is chocolate, 3.6% to the downside. Rough rice, no. Sugar is our winner today, 3.5 points to the upside. Live cattle up 2.5 points. Lean hogs up almost 3 points. Feeder cattle up 1.58%. Gee, I wonder why all these numbers are freaking out. S&P Mini is down 0.5, but the S&P itself is up 0.6%. NASDAQ is up a full point, but the Dow is down 1/3. What could be possibly going wrong? Well, look at Bitcoin's price, $79,400. What the hell happened? We were at 82,000 last night. The Producers Price Index numbers printed this morning at 5:30 a.m. my time. And oh my, oh my, almost 3 times higher than what the economists were projecting. Let me say that again. The Producer Price Index, which basically tracks what it costs producers to produce. Like when we buy shit, we notice inflation, and we're buying the end product, but we're buying them from somebody who produces that product. So the CPI is for us, the Consumer Price Index. The PPI is for the people that produce the things that consumers consume. PPI came in at 1.7. Economists were expecting 0.5. So do the math, man. Do the math. It's almost 3x what the economists were expecting. And that means it's costing the producers a lot more to produce the shit. And they're going to pass that right on to the consumer, which means, yay, we get another round of inflation coming. It's not here yet for the consumers, but it's on its way. It's literally right around the corner. So just be aware, man. I wish I had better news. But if you're wondering what the hell happened to Bitcoin this morning, that's why. And it makes it the more extensive reasoning behind this is it makes it much less likely that the Fed is going to lower rates, which means it's much less likely that there's going to be cheaper money to borrow, which means that there's much less money that's going to be put into higher risk investments. This is the way it goes. Still, looking at a $1.59 trillion market cap, we can only purchase 16.9 ounces of shiny metal rocks with our 1 Bitcoin, of which there are 20,028,666. Another number of the beast mark here. Ooh, numerology freaking me out here. There is average fees per block are 0.02, so that's normal. 40 blocks carrying 84,000 unconfirmed transactions waiting to clear at high priority rates of only 1 sat per vbyte. So I guess all the sellers have already sold. I don't know. Who knows? Low priorities will get you in at 0.3. Hash rate stands at 988 exahashes per second. Still pretty good security for the Bitcoin network. From yesterday's episode of Bitcoin which was named Anthropology. I don't know if anybody got that. It was Anthropic, basically being apologists for their guidance on, hey, if you buy tokenized stock from us, we're, through a third party, anyway, it's okay. Sometimes I hit them out of the park with the title, sometimes I don't. Nick Dose with 211 sats says, cheers, right back at you. Nostr Gang with the short row stick says, thank you, sir. And Cycros with 100 says, money market funds do not need to be short-term debt instruments. No stock, no Bitcoin. My comment to my own comment, talking to myself, last time didn't make it through, so I did point out that banks can still make use of assets in money. Well, I appreciate that. And Cycros, if you're listening to this and you're wondering if it's possible you wrote something longer and I didn't read it, it's because I can't see it. On fountain.fm, for some reason, they've capped the amount of characters that I can read, even though I'm on a desktop computer. Somehow or another, they've capped the amount of characters that I can read. So if you wrote more, let me know and I'll go look for it. But meanwhile, that's the weather report. Welcome to part 2 of the news that you can use. So what's really at stake in the market structure debate? The BRCA, of course. This is Kyle Olney from Bitcoin Magazine, and he's writing this. If I can get it back up to where I need it to be. If you've been following the headlines lately, you could easily be forgiven for thinking that the fight over stablecoin yield is the only sticking point holding the United States back from the crypto industry's long-awaited comprehensive market structure legislation. But sadly, you'd be wrong. For months now, the headlines have fixated on a genuine but ultimately tractable disagreement. Whether crypto platforms should be allowed to share yield from their treasury bill reserves with stablecoin holders, or whether that practice should be restricted to protect traditional banks from competition for consumer deposits. It's a real fight. The American Bankers Association has mobilized their entire lobbying arsenal against it. Coinbase has made it a red line. Senate negotiators have spent months trying to thread the needle, and they'll probably figure it out eventually. But while bank lobbyists and the media obsess over who exactly will get the privilege of pocketing stablecoin interest, Congress is getting dangerously close to gutting the single provision that will determine whether market structure can actually deliver on its promise or ends up crippling the very industry it claims to support. That provision, Section 604 of the current Senate draft, has to do with developer protections and whether those who write non-custodial software can be held liable by the United States government as bona fide money transmitters. Whether this section survives the Senate negotiation process intact will determine the fate of the entire bill. Section 604 carries the policy weight of the bill because if it fails, the broader promise of market structure fails right along with it. And right now, it's cracking. The Blockchain Regulatory Certainty Act, or BRCA, is a narrowly tailored provision with bipartisan origins. It was introduced by Senators Cynthia Lummis, Ron Wyden, and it does one essential thing. It clarifies that software developers and infrastructure providers who do not custody nor control user funds are not money transmitters under federal law. That's it. It doesn't weaken anti-money laundering statutes. It doesn't shield bad actors. It simply draws a line that should have been obvious from the start. Writing code is not the same as transmitting money. Without the BRCA, developers of non-custodial software, the people who build wallets, protocols, and decentralized applications that millions of Americans already use, face potential criminal liability under Section 1960 of the Federal Criminal Code. Not civil penalties, not regulatory fines, criminal prosecution for the mere act of publishing software. We have already seen what regulation by prosecution looks like. In 2025, the developers behind Tornado Cash and Samurai Wallet were criminally prosecuted, not for personally laundering money, not for actively conspiring with criminals, but for writing and publishing code that other people used in ways the government didn't like. Keone Rodriguez and William Lonergan Hill are now locked up serving federal sentences following their respective convictions in what often looks like a show trial. Roman Storm is being re-prosecuted and faces over 100 years in prison. And all this happened despite standing DOJ guidance to the contrary. A Treasury Department that acknowledges the valid need for privacy tools and mixers, and an administration that claims to be the most crypto-friendly in history. No matter what shade of lipstick you want to put on this pig, the message from federal prosecutors is unmistakable. If you build non-custodial software in the United States, you do so at your own peril. If the Senate Clarity Act passes without robust BRCA protections, that message becomes law of the land, and the rational response from every developer, every startup, and every venture-backed crypto firm in America will be the same. Leave. The incentives point in one direction. No founder with competent legal counsel will accept a regulatory framework where writing open source code can land you in a federal penitentiary based on which way the wind is blowing in Washington, D.C. Instead, they'll just incorporate in Singapore or in Switzerland or in the UAE or in any jurisdiction that doesn't treat software engineers like unlicensed money transmitters. A Clarity Act without strong BRCA developer protections won't just fail to bring clarity. It will actually accelerate the very capital flight that Congress claims to be trying to prevent. The developer exodus would be catastrophic enough on its own, but the timing here couldn't be worse because Congress could very well end up strangling a nascent technological revolution that has the potential to generate material GDP growth for decades to come, and that's called the agentic economy. Autonomous AI agents, software systems that can negotiate and transact and execute tasks on behalf of users without the need for human intervention, are emerging as the next great computing paradigm. NVIDIA CEO Jensen Huang projected a $1 trillion agentic AI opportunity at GTC 2026. OpenAI is building models purpose-designed for multi-agent architectures. Institutional capital is flooding in, and the infrastructure these agents need to operate at scale, including micropayments, 24/7 settlement, programmable wallets, and cryptographic verification, it's all built using blockchains. Major technology companies and investors are already moving in this direction. AI agents need permissionless, always-on financial rails. Traditional payment systems with their batch settlements and minimum transaction fees and business hour limitations can't support an economy where machines transact with machines thousands of times per second. Blockchains can. And the developers building the nascent infrastructure are the same developers that the Clarity Act itself threatens to criminalize and drive offshore. We've been here before. Back in the late 1990s, Congress faced a similar inflection point with the early internet. Lawmakers could have imposed heavy-handed regulations on the nascent web, requiring licenses for website operators, imposing liabilities on platform developers for user-generated content, and taxing digital transactions before the market had a chance to mature. They chose restraint, and that decision, deliberate, bipartisan, and far-sighted, enabled the creation of the most extraordinary engine of economic value in modern history. Google, Amazon, Apple, Meta, Microsoft, Nvidia, Tesla, trillions of dollars in publicly traded equity, millions of American jobs, and the entire generation of global technological leadership all trace their origins to a Congress that understood that overzealous regulation kills innovation. The agentic economy could become the internet boom of the 2020s. The question is whether this Congress will show the same wisdom, or whether it will over-legislate a transformative technology in its infancy, ceding what should be a new generation of American economic dominance to competing jurisdictions that won't make the same mistake. Even if we set aside the economic damage likely to follow any official criminalization of crypto and AI software development, the government's current approach to developer liability, which would become permanently anchored by a Clarity Act without strong BRCA protections, represents something more fundamental: a violation of the basic principles of American law. We do not prosecute automobile executives as accessories to bank robberies because the getaway driver used a Ford. We do not charge Google engineers with conspiracy because criminals coordinated an attack over Gmail. We don't indict Microsoft engineers for money laundering because a cartel tracked its financing uses Excel. In every other domain of American commerce, we recognize a foundational legal principle: the maker of a tool is not liable for the tool's misuse. Crypto developers are the only class of tool makers in the American economy being singled out for this retributive treatment. And the tool they are building, non-custodial open source software that empowers individuals to transact without intermediaries, is arguably more aligned with American values of individual liberty, financial privacy, and free enterprise than any technology since the printing press. The BRCA was co-introduced by a Republican and a Democrat. It passed in the House of Representatives with a 70% margin. The principle it embodies, that publishing code is not a crime, should be as uncontroversial as the principle that publishing a newspaper is not a crime. Yet, here we are, watching a Congress that promised to make America the crypto capital of the world negotiate away the one fucking provision that would actually make that possible. Making America the crypto capital of the world was a central promise of the current administration and the congressional majority that rode into office right alongside it. Voters heard that promise, the industry heard it, the world heard it. The Clarity Act, without bulletproof developer protections, would all fall catastrophically short of delivering on that promise. The fight over stablecoin yields will get resolved. Nobody wants to see the digital yuan win because bank lobbyists needed the gravy train to keep running through Wall Street. The regulatory competition between the SEC and the CFTC, it'll get resolved. A new Howey framework will be developed. These are all important details, but ultimately they are just implementation details. The existential question, the one that determines whether there will even be an American crypto industry left to regulate by 2030, is whether Congress will protect the developers who build this technology from criminal prosecution for the act of writing code. The BRCA must be included in any market structure bill. It must be included with teeth, and it must not be diluted, carved out, or traded away at backroom negotiations over provisions that, however important, are not the difference between an industry that thrives in America and one that packs its bags for Hong Kong or Singapore. Congress has a very narrow window of opportunity left. The midterm elections in November look poised to be a political earthquake. The legislative timer in Washington, D.C. is rapidly running out of sand. A generational opportunity for the United States to assert its continued leadership in the new multipolar world order is disappearing. The time to get this right is now, not because the crypto lobby is demanding it, but because American innovation, equal treatment under the law, and continued economic and technological leadership depend on it. The question is not whether the United States will have a market structure bill. The question is whether that bill will be worth the paper it's printed on. And that's the end of the article. Not bad. It's actually a very well-written article. He forgot one major point, though. It ain't just the banking lobby that has thrown their hat into the ring trying to screw with yield. Because that's not what Section 604 is about, right? The banking lobby is worried about something completely different. What I'm surprised about is that he didn't throw in the Fraternal Order of Police. Because now they're in the fight and they are directly targeting Section 604. You're talking about basically I guess kind of like the largest cop union that there is. And there's county cops and city cops and state cops and federal cops and whatever. And they're kind of all represented by the Fraternal Order of Police, or the FOP. Not the only union, but it's something that you don't mess around with. It's sort of like the banking lobby. And all of a sudden, a couple of days ago, they threw their hat in the ring and said that they don't like Section 604 the way it's written, because it's going to allow money laundering and the children and terrorist financing, whatever Christmas paper you want to wrap that hog shit in. That's what they're right there. That's what they're doing. Did it ever occur to a motherfucker on the street to just do police work? Why is it that we continuously erode our rights, our privacy, our humanity? Because some dumb motherfucker that represents maybe 1 in 50 people on the planet decides to be a dipshit. And we just let it happen. No, it's for the children. I was told it was for the children, so therefore you can take from me whatever you want. You know what? I'm like George Carlin. Fuck the children. Fuck the children. Let them find their own goddamn way at this point. No, you know what? I'm sorry. That's up to the parents, isn't it? Or legal guardians. That's our business. That is not the federal government's business. You do not have the right to protect my child. I'm not ceding that right to you. Until my child is 18, my child is my property, and I will do with that property what I wish. And no, I'm not going to throw him over the cliff. Well, it means you're saying you can beat your children. No, let's be reasonable for once, people. No, my children are my responsibility. And if I screw that up, that's on me. I don't need the federal government or the state government or the city government or the county government saying shit about what goes on with my kids. Yet I have grown up basically saying, but it's for the children. And it's only been recently, aka the advent of Bitcoin, that I'm letting all that shit go. Because it doesn't make sense. To have the Fraternal Order of Police attack Section 604 while the banking lobby is hacking down another part of the Clarity Act, these are the enemies. I don't like the thought of looking at a cop like an enemy, but if the Fraternal Order of Police have thrown their hat into the ring that basically denigrates and degrades and otherwise erodes the First Amendment of the Constitution of the United States, then, ladies and gentlemen, I say they can go fuck themselves. Let's move on to the CFTC backing prediction market Kalshi in an appeals court fight against the state of Ohio. Cointelegraph Jesse Coughlin is writing, the U.S. Commodity Futures Trading Commission has backed Kalshi in the company's legal fight against the state of Ohio, asking an appeals court to affirm that the regulator has jurisdiction over prediction markets. The CFTC filed an amicus brief in the Sixth Circuit Court of Appeals on Tuesday, accusing Ohio of jurisdictional overreach after state authorities told Kalshi last year to stop offering sports event contracts in the state, calling them unlicensed sports gambling. Kalshi sued Ohio authorities in October, seeking to have a federal court stop the Ohio Casino Control Commission and the state's attorneys general from taking action. But the court denied the request in March, leading Kalshi to appeal that decision. Quote, the federal district court in Ohio took an improperly narrow view of the commission's jurisdiction, and we are asking the Court of Appeals to correct that error, CFTC Chairman Mike Selig said in a statement. Quote, as I've said repeatedly, the CFTC will not allow overzealous state governments to undermine the agency's long-standing authority over these markets, end quote. The dispute is one of many similar cases determining whether states have the power to restrict federally regulated prediction markets and has implications for major prediction market platforms such as Kalshi and Polymarket. The CFTC's latest amicus brief is its second letter backing a prediction market after it filed one in the Ninth Circuit Court of Appeals in February supporting crypto.com. In its brief, the CFTC argued that Ohio's jurisdictional overreach in the commission's overreach into the commission's sphere of influence threatens regulatory upheaval as the agency oversees event contracts trading as swaps or binary options on designated contract markets. Quote, if states can restrict event contracts on sports, the commission's longstanding jurisdiction over these event contracts could be imperiled too. The court should enforce the commission's exclusive jurisdiction and hold that Ohio cannot regulate event contracts traded on DCMs. The CFTC's brief comes after it sued 5 states to assert its jurisdiction over prediction markets, launching actions against regulators in Wisconsin, New York, Arizona, Connecticut, and Illinois. The states had either sent cease and desist letters or had sued the prediction markets Kalshi, Polymarket, Crypto.com, Robinhood, and Coinbase, all of which are CFTC-regulated DCMs over their offering of sports events contracts. Quote, states cannot circumvent the clear directive of Congress, Selig said last month after the CFTC sued Wisconsin. Quote, our message to Wisconsin is the same as to New York, Arizona, and others. If you interfere with the operation of federal law in regulating financial markets, we will sue you, end quote. Now, I don't know about you, but this sounds like some pretty strong language coming out of Selig and the CFTC. In fact, CFTC before Selig, while it was kind of sort of like in this holding pattern, they kind of had this interim chair or whatever you want to call it. It was pretty weak. It really wasn't doing a lot. And it kind of seemed that way for a while, but my God, dude, Selig seems to be grabbing the bull by the balls and bashing it into a brick wall here. And it's going to be interesting to see how all of these states react. So here's the thing. Am I rooting for the federal government or am I rooting for the states? At this point, I'm kind of not rooting for either. I'm kind of buying a ticket to the show because I want to see a good fight. And that's really shallow of me, and I get it. But the outcome of this fight is going to tell us a lot about what goes on moving forward. Now, what I should be saying, and I'm sure a lot of you out there are saying it, is 10th Amendment. Yeah, I'm kind of, so from that standpoint, kind of am on the state's side. But on the other hand, gaming commissions, dude, all this shit came out of the mob. This is all mafia level bullshit. And since I can't stand gambling in the first place, I think it should all go away. So I kind of don't have much of a dog in this hunt. The only dog I got in this hunt is the 10th Amendment, which I've got a lot of respect for. In fact, I got just as much as respect for the 10th Amendment as I do the first and the second and the fifth and the third and the fourth. Things like that. I'm just saying, Selig doesn't seem like he's going to be the kind of person to back down. And I don't think the states are going to want to do this very much longer. And it depends on just how much battle acumen Selig drags into the fight. I mean, if he really wants to, he can make the states' courts kind of miserable. So this is going to be exciting to watch the slugfest happen. But enough of that. Kalshi and Polymarket and Crypto.com and Coinbase and all the rest of them, they've got a pretty big gorilla fighting in their corner for them. And I, under every circumstance that I can think of, like as of me back in the past, right as I found Bitcoin, coming up through the market, watching bears, watching bulls, watching different kinds of wallets come up and different kinds of exchanges come up, I never once ever envisioned that the federal government would stand toe to toe against people coming after those very things. I figured the federal government would be like, yeah, let's kill them. I never thought we would have been here, not this fast. But dude, the CFTC is shoulder to shoulder with Kraken. Well, let's just say Coinbase and Kalshi and Polymarket and Crypto.com. They're standing shoulder to shoulder in their corner. Like it's their coach or something. It's like fucking Rocky. You know, it's like watching Rocky Balboa fight or something like that in the Rocky movies from the 70s and 80s. I never would have thought that in a million years. So there's a part of me that wants to say this is good, but there's also a part of me that wants to say, watch out what you wish for, man, because you might just get it. I'll see you on the other side. This has been Bitcoin and I'm your host, David Bennett. I hope you enjoyed today's episode and hope to see you again real soon. Have a great day.